Kia ora, and welcome to Shared Lunch. My name's Leighton Roberts. I'm the co-CEO and co-founder here at Sharesies. On the program today, we're talking about everyone's favourite topic, interest rates and the property market. This is ahead of the Reserve Bank meeting to decide if the official cash rate will be cut again. And of course, this dictates what we will all pay on our mortgages or our loans. To chew this over, I'm being joined by independent economist Tony Alexander. But before we get started, here's some important information.
Investing involves risk. You might lose the money you start with. We recommend talking to a licensed financial advisor. We also recommend reading product disclosure documents before deciding to invest. Everything you're about to see and hear is current at the time of recording.
Hey, welcome Tony. Thanks so much for joining us again.
Yep, no trouble, Leighton. Good to be here again.
Oh, look, Tony, it's great to have you here. Very topical timing. I mean, it always is to have you here, and everyone loves talking about interest rates and property market in New Zealand, but specifically with some big changes in the central banks here and overseas over the last little bit, this one's going to be interesting. So I think let's get straight into it. How's it shaping up for the Reserve Bank announcement coming up?
Yes, well, for that next announcement next week, Wednesday, it is likely we're going to see the official cash rate cut again. It would be pretty rare for the Reserve Bank to cut by 0.25%, the start of an easing cycle, and then just take a pause. If they're going to take a pause and see how things pan out, maybe after they've taken the rate down by 1% in a few months' time or so. My interest is mainly, of course, in not whether it's going to cut or not, but will it be 0.25 or 0.5%? And I know a lot of people are thinking, well, because the Americans, the Federal Reserve, just started their easing cycle and went for a big bang 0.5% cut, maybe the Reserve Bank in New Zealand has some catching up to do as well, and they'll go 0.5%. Now, they might, but I can't help think that they'll still decide to, plod it along at 0.25 for maybe another 2 or 3 times, and then, like I say, pause and decide if they need to do a bit more of a rapid move. So, yeah, lower rates are coming.
Yeah, no, I'm with you, and my personal feeling is I think they should go 50, but I don't know. That's very much based on probably personal data. So, interested in your view, what are the more macro pieces of data at the moment that mean that it looks like they're going to hit that 25 as opposed to the 50?
Yes, yeah. Well, if we look at things like consumer confidence, we can see that has improved, but it's still firmly negative. My own monthly spending plan survey, 2.5, almost 3 months ago, I had a net 42% of people saying they were going to cut back on their spending. So terrible news for retailers. Now with interest rates going down, it's improved, but it's still minus 13%. And the ANZ Roy Morgan survey had a similar sort of movement, improving, but still firmly negative. So the central bank will look at that and think, okay, consumer spending makes up about 65% of economic activity. And if people are still saying they're going to be cutting back, bad for retailers, bad for the economy overall, therefore probably inflation going down. However, there's something I've been talking about for quite some time now, and that's the pricing intentions of people in the business sector. And these have not yet been crushed. So the ANZ in their monthly business outlook survey actually have a measure of this we can track on a monthly basis. And if we go back about 3 months ago, they had a net 35% of businesses saying they were still going to increase their prices over the next 12 months, which is well above average. It's gone up to a net 42% of businesses planning to increase their prices. So, things are not necessarily bucketing off with the inflation as much as the Reserve Bank would like. And that is why I'm not convinced it's going to be a 0.5% move in the very near future. They may just still want to take it cautiously initially.
Yeah, because of course you have intent, but you also need the market to support that, right? So you can put your prices up as much as you like, but if people stop buying it because of it, and obviously there's some things that we're just going to have to buy. But is there any data there to say how much capacity the market can really support still? Because from where I'm sitting and hearing, it still seems like a lot of pain out there.
Definitely, I think a lot of pain out there. Businesses generally have got cash flow problems, and that's causing what I predicted about 18 months ago would be a weeding out process across all business sectors this year. As the cash flows tighten up, customers aren't buying as much. The IRD is chasing up on tax obligations. Savings buffers that were built up during the pandemic have been used up as well. And so that means for businesses, they definitely would like to increase their prices out there because for most of them, the costs are still going up. And this is why in my many talks, I've been noting to people that At some stage, like around about now, 18 to 24 months down the track from the real tightening of monetary policy in November 2022, this is when you've got the greatest pressure on businesses, on the cash flows, and this is when the businesses will be having meetings and saying, well, our costs have just gone up another 8%. We've got to increase our prices 8%. It's worked before, so let's keep doing that. But then the marketing manager is going to jump up and say, we can't do that because the customers are already shopping more and more online. They're pulling back on what they're buying generally. We've got unsold goods building up in the warehouses. We're not going to get away with an 8% increase, maybe 2% if we are lucky. And that's the environment we are in for the economy right at the moment. And that's why I wouldn't have cut the official cash rate back in the middle of August. I'd have kept the throat on the foot on the throat of businesses just a bit longer to really get away those positive pricing intentions. For businesses, of course, I mean, you might have your costs go up 8% and you can't increase your prices. Then you've got to make some hard decisions. You've got to start laying people off. You've got to cut back to only your most profitable products, processes, people, locations. That's the disturbed part of the economy that we are in at the moment. And it says to me a lot of the economic indicators are still going to be fairly poor for the rest of this year through to maybe the middle of next year. And then I expect a more solid upturn in the economy.
Yeah, interesting. Just for my own interest, is there much in the way of seasonality? Data point of one, this weekend was absolutely humming in Wellington. Admittedly, it had it had an All Blacks test, but it also had some good weather. And it just seemed like there's more activity out in town. I'm just interested how that might flow through into summer.
Yeah, I'd be pretty cautious about summer. I think people's behaviour is changing quite a bit out there. Hey, an All Blacks test on, yeah, clearly a lot of people are going to be showing up. They may have put money aside from other things and decide that's when we're going to have a blowout. We're going to watch the game and then we're going to go to a bar or a restaurant afterwards or before, etc. But we saw data out recently showing that spending in takeaways has gone up. And my own experience of going to cafes these days is I'm paying prices I used to pay, like I'm thinking only 3 or 4 years back, going to a restaurant. And I'm thinking to myself, well, maybe if we are going to go out and have something to eat, frankly, it would be cheaper just to go to McDonald's, any other sort of takeaways like that, and maybe the fish and chip shop, rather than paying $15 for a little phyllo pastry, a mushroom and chicken roll out there. I balk at doing that. People are changing the way they spend money. And so you might still get people out and about, but they won't necessarily be spending as much in the retail, the hospitality outlets as before. And yeah, when the weather's good, you've got to get out in Wellington because you know what's just around the corner. It's going to revert to normal fairly quickly.
Yeah. Let us talk a little bit about unemployment. You touched on, some actions that businesses need to take and a weeding out process that's happening at the moment, but what's that trending like at the moment?
Yeah, we've already seen the unemployment rate rise from an unsustainably low 3.2% a couple of years ago to 4.6%. And it's likely that the unemployment rate will keep rising towards 5.5%, sort of best estimate for most of us out there. And that principally is because we're seeing businesses, as I say, across all sectors, not just, house building is falling away and so you're getting unemployed carpenters, etc. Across all sectors, businesses are having to sort of trim their sales there, find cost savings, change what they do and how they do it. And as we go through that prices, meaning businesses can handle costs still rising and not have to put their prices up on the other side, yet the unemployment rate is going to go up. And what interests me here is that for younger people out there who, let's say, even joined the workforce, took your first job 10 years ago, this is a totally new thing because all you would have known to date will have been a generous employment environment. The unemployment rate was 4% going into the pandemic. There were predictions it would go through the roof, and that was pretty concerning. Well, it only briefly went to 5.3%, and then boom, with all the money thrown around in the economy, went to 3.2%. Now we have a more sustained, cyclically normal increase in unemployment, and a lot of people have not seen this before. So job security has gone down out there, and I think that especially is hitting into the willingness to spend, make big decisions of younger people, as opposed to older people, middle-aged, baby boomers, etc., who've seen a lot worse in the past, unemployment rates around 11% or so, and not quite so negatively affected by that particular dynamic. But certainly for younger people, this job insecurity is likely to be probably around until late 25, more probably 2026, and that'll be a cap on some of their willingness to spend out there.
Yeah, that's pretty grim listing, isn't it? But it's super interesting from someone who owns and runs businesses as well. It's my first time through this sort of cycle. 2008, which I guess was the last major sort of economic crisis, I was in the army and pretty much oblivious, which still fascinates me given how interested in finance and money I was. But really learnt about that when I started university in 2009, 2010, but haven't actually experienced the cycle play out and how different things can turn so quickly. But on the other side of that, it gives me optimism that they can turn the other way reasonably quick, and maybe we'll talk about some of the things that could drive that soon. But let's just keep hitting with the key macro numbers at the moment. We've got migration. Where's that at the moment, and what sort of impacts that having, and any views on the brain drain that we're hearing a lot about?
Okay, first point to note about migration, if it really drove the economy as much as people have traditionally thought, then we wouldn't have had a recession lasting almost 2 years, because the net migration gain, it boomed from about 24 months ago. We had a record net gain in the year to October last year of 137,000 people net. So that's those coming in, less those going out. There's 137,000 in there. That's a strong boost to the population. In fact, our population has grown about 2.1% in the past year and 4.4% from where we were 3 years ago. So lots of people sloshing around, and yet still our economy has been phenomenally weak. Now the net migration numbers are falling away relatively strongly, and in the year to August, I think we're up to for the data there, August or July, it's a net gain of about 67,000, but we're heading down to something, who knows, maybe around 20,000 as a net gain or so, and I can already see the impact in the rental market. If we go back a wee ways, a year and a half ago, I had the likes of a net 24% of landlords in one of my surveys saying it was easy to find good tenants. Lots of people sloshing around in the middle of 2023. Now I have a record net 22% of landlords saying it is hard to get a good tenant. So that rental market has actually shifted on a dime. One thing contributing to that has been some developers who have not been able to sell their, let's say, townhouses up in Auckland in particular. They've put them into the rental market for a while, waiting for the housing market to pick up, and then they'll go and sell them to end buyers. But migration has an impact, certainly in the rental market, but for the overall economy, it's not the big driving force necessarily that people would be thinking. And so as we look now towards a weak net migration period and more of a focus on Kiwis going to Australia in particular, it doesn't leave me aggressively depressed about the economy. It will be some restraint for sure. It'll be something that people will focus on, but it won't stop the economy's pace of growth from turning positive, accelerating through 2025, 26 and probably 2027 as well, because there's a lot of other factors in play. Increased infrastructure activity out there, probably more foreign students coming into New Zealand as well, the real estate activity picking up, and eventually that will lead to house building picking up in 2026, not 2025. But yeah, migration numbers, they're turning around reasonably quickly at the moment.
Yeah, just if you have them off the top of your head, how's that net number being made up at the moment? Is the sort of the number coming in, and is the number going out being more impactful, or is it the number coming in is dropping off? Like, what's making up that net number?
Yeah, the two numbers tend to move together to worsen the situation. So we do have a few more people that are leaving the country. That's especially some Kiwis that are leaving the country, and people who came in on short-term working visas 2 years ago are now leaving the country as well. So there's quite a dynamic going on there. The number coming into the country while falling away at the same time. So you take the stack of those coming in, falling, those leaving, going up, and boom, you can get a pretty quick change as the New Zealand historical experience in the net flow. And that's why actually forecasting population growth in New Zealand is a complete dog's breakfast, because forecasting net migration flows, I remember first proving this back in about 1992, you can't do it. They can't do it in Australia either, because these flows are so strong on both sides of the ledger. Doesn't take much of, one or both of them moving, and the numbers can change fairly quickly. So people should just be aware that when we get a bit more downward momentum picked up in the media about the net migration falling away, there will be extrapolations into negative numbers. And if a journalist comes through to me and say, is it realistic that we could have a net outflow again of minus 20,000 people in a year's time? I'm going to have to say yes, because we don't know. You can't predict it.
All right, it's possible. Super interesting. So let's just get to probably what most people want to talk about in property and the impact that it's going to have on that, huge impact through to New Zealanders and across the economy. So firstly, what are you hearing out there at the moment? What's the anecdotal talk and what's the data showing us? And are they similar, or are they quite different?
Yeah, no, the anecdotes and the data would be similar. And so if we look at some of the data in terms of price movements, and I use the REINZ's monthly nationwide house price index measure there, in the 3 months through to May, on average each month, house prices fell 1% around New Zealand. But in the 3 months since then, what's that, June, July, 3 months to August, on average, house prices have fallen only 0.3%. So they've still been falling. In the month of August, they were flat. So I'm prepared to say right now, at September, end of September, start of October now, we are in the low point of the house price cycle on average. And from here, the prices will start to rise, but not necessarily rapidly. And that's because of what's happening with both demand and the supply of property. So if we look at the demand side, I can get a really good feel for what's happening at the coalface from my monthly survey of residential real estate agents. And about 3 months ago, it was pretty dire. I had a net 35% of the agents saying there are fewer people at open homes. No one's showing up. No one's drinking the coffee, eating the donuts, etc. And in my most recent survey, I'll be sending a new one out any day now, but 4 weeks ago, a net 42% of agents were saying there are more people showing up at open homes. I've got similar strong movements towards the positive territory when I ask them, are there more first home buyers showing up? Are there more investors showing up? So I can show definitively from my survey there, yes, the buyers are out there. They're looking at property. They are going out to starting to go to the auctions now as well. Now, what about on the other side? What we can see is that there are more vendors who are coming forward as well. So at the end of August, the number of properties listed for sale was up about 30% from a year earlier, at the highest number nationwide, about 34,000, highest number since 2015. And again, when I ask the agents, are you seeing more or fewer people come forward asking for property appraisals? I mean, you do that if you're thinking about selling. I think I had a net 50% most recently saying, yeah, there are more people wanting to know what their property might get if they were put it in the market. So this is where it gets interesting. For real estate agents, this is fantastic news. More buyers and more sellers coming through. So good real estate turnover is in the offing. I expect seasonally adjusted improvements in sales. But what it does to prices, as an economist, I've got to say, you can't really tell. If both demand is rising and supply is rising, nothing obvious pumps out in terms of the new equilibrium levels of prices. My expectation is, however, with the interest rates are falling out there and they're having quite an impact on people's optimism, you will see prices edging up. But we're not seeing anything in terms of, in my view, of prices taking off for a long time. And even if we go back to previous cycles, it usually wasn't until about 4 years after prices bottomed out that you really got things cranking along with nationwide prices rising over 15% for the year, for instance. So prices rising fairly soon, but at a relatively mild pace initially, I'd suggest.
What I am hearing is quite a few people in a bit of a rush now, which is, not a massive case study of people, I'd say, but those anecdotes coming in again, sort of that I don't want to miss the bottom of this market for those who can afford to. So it is interesting just seeing that language change, and I wonder how much of that is specifically attributable to the interest rates environment changing.
Yeah, I think the interest rates, people have enough awareness of what that is going to do to the housing market, eventually to the economy overall. There have been a lot of people who have been sitting out of the housing market, wanting to buy, but not willing to make a move with so many uncertain times, low job security recently and the interest rates being high, who are now looking at getting in because they know eventually there'll be greater momentum out there. They know more investors will start looking again. Once the price of a thing gets upward momentum, it drags investors into that market, as we can see with the price of gold, for instance, internationally at the moment rising, and so it keeps rising for a while. And although I think the high job insecurity for a while will give reason for pause for many people, a lot of young people have been building up a strong deposit for a number of years now, and not everybody is being laid off. And so we are definitely seeing first home buyers realise or making the decision of, if we move now, it's going to be better than if we wait. We're still going to be paying a higher interest rate than we really want, but the rate is going to get better, so let's only fix for 6 or 12 months, and then we'll get a more affordable interest rate, 12, 18, 24 months down the track.
Yeah, there's a few things at play there, isn't there? Because what the specific person I was talking to about this has savings balances, and at the same time is starting to see those deposit rates. They're not really in that 6.5% range that we're getting not so long ago. So they're seeing that roll on to different amounts. Most of them recognise KiwiSaver is at a pretty good level. We've got the S&P back at record levels, and KiwiSaver is a well-used tool in that world. So yeah, super interesting to see how that plays out for first home buyers over the next little bit. I just want to get into Chris Bishop is very vocal at the moment in the stance on loosening regulation to bring house prices down. What's your thoughts on that? And is it a slam dunk, do you think?
Not a slam dunk in terms of getting house prices down. Everybody talks about that until they think about, hang on, there are more of us with houses wanting prices to go up than there are people who don't have houses and want house prices to go down. And this is where the votes lie with the homeowners. So I don't expect the government will have such strong policies that there's a massive flood of new house construction out there where house prices will be falling and expected to fall in New Zealand over a number of years. Generally, people associate that with bad economic times, and it generally doesn't go down too well for a government getting re-elected when that happens. So I don't believe that they're going to have slam dunk huge policies that cause house prices to fall on a sustained basis. But what the changes that they are looking at making will be one of the strong factors suppressing the pace of price increase this cycle. And if we have a look at the learnings we've got from our two biggest cities over the past, decade, from Christchurch, Canterbury, 2015, we saw a freeing up of huge quantities of land zoned as residential. And following that, we saw the increase in section prices around Christchurch be much, much less than in the rest of the country over that period, 2015 through to 2020 or so. Make more land available, you control the land prices. They don't rise so much as people are out there looking to buy and build. And the example from Auckland with the unitary plan coming in from 2016 is if you allow greater densification, you will get greater intensification of the land, more units being built. And this is one important dynamic out there. So if we go back to the global financial crisis, things got bad, house building fell away, and at its low point in 2011, so sort of 2 years after the crisis there, the number of consents issued for new dwellings to be built in New Zealand was below 14,000. Now, we've seen the number of consents fall away from 2 years ago, a record high level of 51,000. We're at 34,000 now, but we're probably only going to go down to maybe 30,000 or so, a decrease in the production of townhouses. That underlying house supply dynamic is structurally changed now. Already there are more places being built, and the supply dynamic structurally is different from what it was before. And more moves are going to be made by the government to improve supply, especially if they move on the building consent area there. It can only be positive, quite frankly, going forward.
Yeah, nice. So you predicted trouble afoot for developers not so long ago, and there's now has been a few high-profile instances where that's played out. What's your sense of how many more might be on shaky ground in the property development space?
Yeah, hard to know, but I do think there is more negative news to come along there, in that it is very difficult for these developers to get pre-sales, and if you can't get pre-sales, then you can't get the financing from the banks there. So not so much for group home builders or even individual builders, but for the multi-unit developers out there, that's where I think there's still some negative news over the next 12, maybe 15 months or so. there's a bit of a lag in the cycle in that you get standalone house building doing a certain thing, and then the multi-unit developments, they may be 12 months behind in their cycle. So I'll have a view on multi-unit development going up once I can see individual house construction going up. And that's going to be a story from some point in 2025, probably in the second half of the year. But with the IRD certainly chasing unpaid tax bills, that's been a new dynamic this year in New Zealand. Exactly the same across the ditch in Australia as well. The ATO, the Australian Tax Office, getting in touch with businesses and saying, pay me my money. We've got a similar, even if slightly less strident thing happening in New Zealand as well. The cash flows, that's what puts businesses under. And like I say, for all sectors, there are some cash flow problems, but I do think there's a few more adjustments to happen in the property development sector as well.
They're just such large numbers, aren't they, and can be quite fickle, move quickly. Just a couple of quick fires. So capital gains tax, for me, I've always felt like it's more of a when, not an if, but again, it's topical, and both political parties, business leaders speaking about it. What's your view on capital gains tax?
Yeah, I expect it will be introduced at some stage in New Zealand. It's a question of what will be the context of the debate. And if the debate for introducing it is revolving around envy and not wanting people to make a capital gain from property, and a belief that, if people don't invest in property, they're going to invest in other, productive activities, I don't know if it gets across the line. From my point of view, to get it across the line, it has to be in the context of the country needs to generate more tax revenue in the future because of the ageing population, the increased demands on the health system, for instance, just to modernise what's already sitting out there. We do need to raise more revenue. New Zealand is already highly dependent upon income tax, and GST rate is already 15%. Put it in that context, and I can see myself probably voting in favour of it coming in. But as long as it is couched in terms of some people have made money and we don't think they should have made that much money, I would struggle then, I think, to go and support it. It has to be part of a broader fiscal debate. But it's going to come, but I think it's impossible to predict what parliamentary term it's going to appear.
It'll be if someone can nail that story of, it'll help mean more growth over time and stuff. I think that would be amazing as well. So for our listeners, what should they as investors be thinking or bearing in mind over the next 6 to 12 months?
Yeah, expect a lot of uncertainty out there. We're at a turning point in a number of cycles. And my experience of having been in this business back in New Zealand since 1987 is that we're a volatile economy. We get hit by shocks all the time, domestic ones and offshore. And when cycles turn, sometimes they don't keep going in the direction that you expect. This happened a year ago. The housing market was picking up quite strongly. Prices on average in New Zealand increased 0.9% a month for a 5-month period, July through to November, and then they started falling away. It was a false start. I don't think it's a false start this time around in terms of the residential property market picking up. But there are a number of things out there that are going to occupy people's minds. And so obviously keep an eye on what's happening in the Middle East and the potential for, greater discord over there that may cause an impact in the oil market. It hasn't so far, but that is always a risk that's sitting out there. We've got the American presidential election in about a month's time coming along. And if Mr. Trump gets back in, then we're looking at higher tariffs for the 13% of New Zealand exports that go to the United States. And then other countries may be looking at putting tariffs in place as well. So that's a risk for New Zealand because we're vulnerable to these things and we need access overseas. Keep an eye on the Chinese economy. At its peak 3 years ago, 33% of our export receipts came from China, including Hong Kong. Now we're down to 27.3% and falling away. China's economic outlook is not particularly good, and that means still low demand for forestry products, and it's going to be suppressing prices for the likes of red meat, and I'd suggest also a bit on the dairy product side as well. So keep an eye on that one. And outside of that, it's simply the usual things. At some stage, we're going to get another decent earthquake, a big earthquake, unfortunately, in New Zealand. I don't tend to buy into, there's another pandemic just around the corner. One in every 70 years in terms of, COVID, etc. Maybe that is more my underlying assumption with that regard. But people need to remember diversification in your portfolio and watch for over extrapolation of cycles once they start, because I can assure you from 3.5 or so decades in this business, there isn't a tendency to over extrapolate the up and the down. Things move in cycles, and watch out you don't get overly optimistic or pessimistic the other way around.
It's one of my favourite quotes actually from one of the Sharesies shareholders. Told me early days of the pandemic when we didn't know what was going to happen, but his words of advice to me, maybe I was looking a bit stressed, was nothing is ever as good as it seems and nothing is ever as bad as it seems. It's always just somewhere in the middle. So that's a great summary. Thank you, Tony. And very much appreciate you joining us on Shared Lunch again today. And thank you also everyone for tuning in. You can watch Shared Lunch wherever you get your podcasts, and leave us a rating and a comment about what you'd like to hear about next.